£38.3 billion. That's how much British banks and lenders have paid back to customers over one insurance product. It's the largest consumer redress exercise in the history of this country, and it isn't close. 32.4 million complaints were made about it. In the final month before the deadline, more than 1.4 million people complained in 31 days. The product was Payment Protection Insurance, PPI. It was sold alongside loans, credit cards, mortgages, store cards, and overdrafts, and the pitch was straightforward. If you lost your job, or got ill, or had an accident, the policy would cover your repayments. Given that you'd just taken on a debt, that sounds like a sensible thing to have. The usual explanation for what went wrong is that banks got greedy. They pushed a product on people who didn't need it, some of whom couldn't even claim on it, and eventually they got caught and had to pay it back. That explanation is true as far as it goes. It just doesn't explain the scale. Because £38 billion isn't the sort of number you reach by being greedy at the edges. It's the number you reach when something was working exactly as intended, at industrial scale, for about 20 years, in plain sight. So the question worth asking isn't why banks sold it. It's what they were actually selling. To answer that, we need one number from a court case. In 2014, the Supreme Court heard a case called Plevin against Paragon Personal Finance. The facts were unremarkable. A woman had taken out a secured loan, and with it a PPI policy costing £5,780. Nothing about that was unusual. Millions of policies like it had been sold. What made the case matter was what the premium turned out to consist of. Of that £5,780, £4,150 was commission, paid to the broker and the lender. 71.8%. The actual insurance, the part that would pay out if she couldn't work, cost £1,630. She hadn't been told that. There was no rule at the time requiring anyone to tell her. Sit with the ratio for a moment, because it reframes the entire product. For every pound she handed over, roughly 72 pence went to the people selling it and about 28 pence went towards insuring her. That isn't an insurance policy with a high commission attached. That's a commission with a small insurance policy attached to make it saleable. The Supreme Court's reasoning is worth understanding, because it's narrower and sharper than people assume. The court didn't rule that high commission was illegal. It ruled that at some point commission becomes so large that keeping the borrower in ignorance of it makes the relationship between them unfair under the Consumer Credit Act. The court declined to say exactly where that point sits. It only said that 71.8% was, in its words, a long way beyond it. 3 years later the regulator drew the line the court hadn't. In rules that came into force in August 2017, the Financial Conduct Authority required firms to pay redress where undisclosed commission and profit share exceeded 50% of the premium. 50% became the threshold. Anything above that, undisclosed, meant money back. Think about what it means that a rule like that was necessary. The regulator had to write down, formally, that taking more than half of an insurance premium as an undisclosed fee was unfair. That's not a rule you need unless the practice was widespread enough to require one. And the regulator estimated that around 1.2 million customers who had already complained, and already been turned down, might now be eligible under this different reasoning. Turned down once, on the old grounds. Potentially owed money on the new ones. So how does a product like this get sold, at that scale, for that long? The answer is in where it was sold. PPI wasn't a product you went looking for. It was offered at the exact moment you were applying for credit, by the person deciding whether to give you the credit. And that moment is unlike almost any other in consumer life. You've already decided you want the loan. You're focused on whether you'll be approved. You're often filling in forms, in a branch or on a phone call, with someone who has the answer you want. And into that moment arrives a second product, described briefly, priced in a way that folds into a monthly figure you're already thinking about. Nobody in that situation shops around for payment protection insurance. There's no comparison. There's often no clear sense that a separate purchase is happening at all. In some cases, the premium was added to the loan itself, financed over the term, meaning the customer paid interest on their insurance for years. That's not a sales technique. It's a structural advantage, and the competition authorities said so. The Office of Fair Trading referred the PPI market to the Competition Commission in February 2007, after Citizens Advice submitted a formal super complaint about it in September 2005. The Commission concluded there were features of the market that prevented, restricted or distorted competition, and made a formal order to address them. Read that finding carefully. It isn't a finding that firms behaved badly. It's a finding that the market didn't work. Those are different problems with different solutions, and only one of them can be fixed by telling people to behave better. And here's where the whole thing turns over. Because if you accept that PPI was mostly a commission wearing an insurance costume, and that it was sold at a moment engineered to prevent comparison, then the phrase mis-selling starts to fall apart. Mis-selling implies a deviation. It implies there was a correct way to sell this product, and that people departed from it. But a product where 72% of the price is the seller's fee doesn't have a good faith version. Nobody would buy it if the ratio were on the front page. The non-disclosure isn't a failure of the sales process. It's a requirement of it. Which means the industry wasn't selling insurance badly. It was selling something else, successfully, and calling it insurance. That reframe explains the thing the greed story can't, which is the sheer duration. Bad behavior gets found out. Products that work as designed run for decades, because everyone in the chain is being rewarded for exactly what they're doing. The branch staff hit targets. The lender books the commission. The insurer collects a premium on a policy with modest exposure. The customer sees a small addition to a monthly payment they'd already accepted. Nobody in that chain had to be a villain. That's what makes it durable. So what happened when it finally broke? The regulator introduced rules on how complaints had to be handled, and firms began paying redress. Then, in 2017, it did something unusual. It set a deadline. Complain by the 29th of August 2019, or lose the right to. The reasoning was that the process needed an ending. Complaints had been running for years with no natural conclusion, and a deadline would push people who hadn't acted into acting. So the regulator ran a 2-year advertising campaign to tell them. It worked, on its own terms, and the numbers are extraordinary. During the campaign, 46.7 million checking inquiries were submitted. In the final 14 months, 8.9 million complaints came in, against 3.7 million in the first 10 months. In the last month alone, 1.4 million complaints and 16.9 million inquiries. Firms paid over £9.1 billion during the campaign period. And in over 80% of cases where a customer had held a PPI policy, redress was paid. 80%. That's the figure I'd hold on to. When people who'd had this product asked whether they'd been treated fairly, 4 times out of 5, the answer was no. There's an uncomfortable coda to all this. The scale of the redress created an industry of its own. Claims management companies advertised heavily, submitted complaints on people's behalf, and took a percentage of whatever came back. Many of those people could have complained directly, for free, in an afternoon. So a portion of money paid out to compensate consumers went instead to firms whose entire business was standing between the consumer and the compensation. That's not a scandal in itself. But it does rhyme with the original problem, which was an intermediary taking a large share of something the customer thought they were buying directly. So what changed? Formally, quite a lot. Commission disclosure rules exist now where they didn't. The regulator has powers and expectations it lacked in 2005. Selling practices at the point of credit are supervised in a way they weren't. But the structure that made PPI possible hasn't gone anywhere, because it isn't a rule. It's a position. Whoever is standing between you and a thing you've already decided you want has an advantage that no amount of disclosure fully removes. They control the moment, the framing, and the order in which you learn things. That's why the same shape keeps recurring in different markets, with different products, and a different regulator response each time. The commission moves. The point of sale moves. The advantage doesn't. And here's the part one keep coming back to. £38.3 billion was paid back. That sounds like a system working. A wrong was identified, quantified, and reversed at enormous cost to the people who'd caused it. But look at the timeline. Citizens' Advice raised the alarm formally in 2005. The competition authorities confirmed a broken market by 2009. The Supreme Court clarified the commission problem in 2014. The regulator set its threshold in 2017. The deadline fell in 2019. That's 14 years from the first formal complaint to the door closing, and policies had been sold for roughly 2 decades before that. Every stage of that was a correct decision made at a reasonable pace by a competent institution. And the total time it took was longer than most people's mortgages. That's the thing worth taking away. The redress wasn't the system succeeding. The redress was the invoice for how long the system took. £38 billion is what it costs to unwind 20 years of a product that made sense to everyone selling it and nobody buying it. Nobody was ever going to read the small print and discover that 72% of their premium was a fee, because it wasn't in the small print. It wasn't anywhere. And the fix, when it arrived, wasn't better information for consumers. It was a rule saying that above a certain point, silence itself is unfair. That's an odd sort of consumer protection. It doesn't help you decide. It just accepts that you were never in a position to.